Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. Today we're talking dividends, and not just any dividend stocks, but 3 US companies that I think deserve a spot on your radar right now. These stocks aren't just about a nice yield today, they've also got the growth, stability, and cash flow to keep paying you over the long run. I'll break down what each company does, why I like them, and how they fit into a dividend-focused portfolio. So let's jump straight into it. If you enjoyed these 3 dividend stocks to buy videos, make sure to hit the like button. If we can get this one to over 100 likes, I'll keep the series going and bring you more stock picks every single month. And the first stock in today's video is Applied Materials, stock ticker AMAT. It is a leading American corporation that provides manufacturing equipment, services, and software used to produce semiconductor chips, display panels, and related advanced electronics. Headquartered in Santa Clara, California, the company is one of the world's largest suppliers of semiconductor fabrication equipment, offering technologies for deposition, etching, inspection, and metrology that enables chip makers to design and scale smaller, faster, and more efficient devices. Beyond semiconductors, Applied Materials also plays a role in materials engineering solutions for flat panel displays, solar technologies, and other emerging industries, making it a cornerstone supplier for the global electronic supply chain. And as we can see on the screen right now, the 1 month performance chart is down 11.78%, which is exactly why it's caught my attention. Their current price is $163.81. They're part of the information technology industry, have a market cap of $130 billion. When public back in 1972, have a very nice 7-year dividend growth streak, but a phenomenal 5-year dividend growth rate at 15.39%, and a yield that now sits at over 1% at 1.14. This is the lowest yielder out of the 3 in today's video, but if you're a long-term patient dividend investor, I feel it could be a stock that'll pay off. Applied Materials delivered a strong performance in Q3 2025 with $7.3 billion in revenue, up 8% year over year, and a record non-GAAP EPS of $2.48, outperforming analyst expectations. The company achieved a healthy gross margin of 48.9%, a 150 basis point improvement year over year, and generated $2.6 billion in cash from operations, 36% of revenue, the second highest in its history. All core segments exceeded expectations, and Applied Materials continues to strengthen its future positioning with a robust innovation pipeline in advanced packaging and core services. As we can see on screen, their 12-month Wall Street estimates have the lowest forecast at around about an 8% downside on that current price, but the average forecast is a little bit more optimistic, with a 20% upside over the next 12 months, being priced at $197.33, and on the highest forecast having a 54% upside on the current price, being valued at $252. And when plugging in my numbers for their intrinsic value, we can see that they were valued at $156.84, which would be a 4% overvaluation. I think that Applied Materials does still stand out as a strong US dividend stock to buy in September because it sits at the center of long-term growth trends like artificial intelligence, high-performance computing, and advanced chip manufacturing, all of which require its cutting-edge equipment and services. The company benefits from a highly diversified revenue base across semiconductors, services, and display technologies, which helps smooth out industry cycles and provides steady cash flow to support shareholder returns. Management has a consistent track record of returning capital through dividends and share buybacks, underpinned by robust free cash flow generation. On top of that, Applied Materials scale, technological leadership, and deep partnerships with major chip makers give it a durable competitive edge, making it well positioned to keep rewarding long-term investors even as the industry evolves. So for me, even though Applied Materials may be trading at a fair price, for a company of this quality, they are the types of companies that I would be looking to buy at a fair price rather than a good price, because over the long term, I can see this one rebounding well and not only having a phenomenal growth rate throughout the years, but also fantastic capital appreciation. If you've been thinking about getting started with investing, this is one of the easiest ways to begin. I use Freetrade, a commission-free investing app that makes buying and selling shares simple and transparent. The platform is clean, user-friendly, and you can invest in UK and US stocks without worrying about hidden fees. And right now, if you sign up using the link in my description and deposit just £50 in your account, you'll get a free share worth anything between £10 and £250. Oh, and I might add that if you're unsure what to invest that £50 into, don't worry about it. You will still receive your free share even if you don't invest that money. It's a great way to start building your portfolio with zero risk on that first step. Check out the link below and claim your free share today. The second stock we're going to look at in today's video is Comcast Corporation, stock ticker CMCSA. I know many of you watching lean towards higher yielding dividend stocks, and with these next two picks, you're not only going to get an attractive current yield, but also strong growth potential alongside it. Comcast Corporation are a global media and technology company headquartered in Philadelphia, best known as one of the largest broadband, cable and media providers in the United States. Its operations are divided into three main segments: connectivity and platforms, content and experience, and theme parks. Comcast is the nation's largest broadband provider, serves millions of residential and business customers, and owns valuable media assets that give it a strong presence in both traditional and streaming entertainment. This combination of recurring subscription revenue, diversified media holdings, and global theme parks makes Comcast a diversified player in both technology and entertainment. And as you can see on screen right now, year to date, the company is down over 10% with a current price at $33.56. They have a market cap at $126.66 billion. When public back in 1972, have a 16-year dividend growth streak alongside a very healthy 5-year dividend growth rate at 7.63%. And with that price being down over 10% year to date, they now have a dividend yield that sits at a very attractive 3.88%. And as we can see on Stockopedia, they have a phenomenal quality rating at 92 with a score on the value at 94, bringing their overall stock rank to a very impressive 96. Comcast delivered a solid performance in Q2 2025, posting adjusted earnings per share of $1.25 and revenue of approximately $30.31 billion, both beating analyst expectations. The company generated a hefty $4.5 billion in free cash flow and returned $2.9 billion to shareholders, including $1.7 billion in share repurchases. Comcast achieved record wireless momentum by adding 378,000 new Xfinity mobile lines, marking its best quarter ever and reflecting strong convergence strategy execution. In their theme park segment, the launch of Epic Universe drove a staggering 19% revenue increase in that segment, even though the park was open for just 1 month during the quarter. Meanwhile, streaming via Peacock posted 18% revenue gain, meaning it reached about $1.2 billion in revenue and improved its EBITDA losses dramatically. So the company has not only seen strong earnings and revenue beats, outstanding cash flow, but also wireless subscriber growth, theme park boosts, and streaming momentum, reflecting a well-executed strategy across Comcast's diverse business segments. And when having a look at their 12-month Wall Street estimates, they believe on the lowest forecast that there could be around about a 7% downside on the current price, being valued at $31.31. But if we look at the more optimistic forecasts, on the average forecast, they actually see a 23% upside, being valued at $41.37. And on the highest forecast, potentially seeing a 75% upside on the current price. When plugging in my numbers for the intrinsic value, we can also see that the company was valued at $57.90, which would mean at their current price they have a 42% undervaluation. I think Comcast is a compelling US dividend stock to consider in September 2025 because it combines the stability of a utility-like broadband business with the upside of a diversified media and entertainment empire. Its massive subscriber base in internet and wireless provides steady, reoccurring cash flows that underpin consistent dividend payouts, while growth engines like Universal theme parks and Peacock streaming add long-term expansion potential. Comcast also has a history of disciplined capital returns through both dividends and share buybacks, supported by strong free cash flow generation. With its scale, brand power, and ability to adapt across connectivity, content, and experiences, Comcast offers investors a rare mix of reliability, growth, and shareholder-friendly policies, making it an attractive choice for dividend-focused portfolios. And the final stock we're looking at in today's video is going to be Conagra Brands, stock ticker CAG. Conagra Brands is one of the largest packaged food companies in the United States, known for its wide portfolio of iconic grocery and frozen food brands found in millions of households. Headquartered in Chicago, the company sells its products primarily in North America through supermarkets, mass retailers, and food service channels, with a strong focus on convenience, affordability, and innovation in both traditional and healthier product categories. Its scale and ability to adapt to changing consumer trends make them a key player in the packaged food industry. As we can see on screen, out of the 3 stocks I'm showing in today's video, this one has been hit the hardest so far year to date, being down 32.2%. They're currently priced at $18.81, have a market cap at $9.15 billion, went public in 1973, have a 5-year dividend growth streak and a 5-year dividend growth rate at 10.49%, with a monstrous yield at 7.31%. When diving deeper into the company's earnings call, they showed encouraging signs of progress, especially in its frozen snacks portfolio, where 91% of snacks brands gained volume share year over year in Q4, reflecting strong consumer appeal and effective portfolio execution. And in Q2 of 2025, the company returned to organic net sales growth of plus 0.3%, driven by volume increases in key grocery and snack categories, including microwave popcorn and shelf-stable entries, and achieved improved operating profits in that segment, up 5% to $293 million. Additionally, Conagra's international segment posted a solid rebound, with adjusted operating margins improved by 167 basis points, aided in part by having a lower margin business. These bright spots underscore how their strategic focus on its high potential frozen and snack brands, combined with operational improvements, continue to yield tangible results. And when having a look at their 12-month Wall Street estimates, this company has the best, lowest forecast out of the 3 stocks in today's video, potentially only seeing a 3% downside over the next 12 months, but on their average forecast, having a potential 16% upside, being valued at $21.74. And on their highest forecast, potentially seeing a 56% upside, being valued at $29.29. When plugging in my numbers for their intrinsic value, I also found them to be very undervalued, being valued at $29.22, which would mean at their current price they have a 36% undervaluation. And with these numbers, that's why I believe this could be an appealing US dividend stock to buy in September 2025. They offer investors stability, resilience, and consistent shareholder returns backed by a portfolio of everyday household staples. The company owns a diverse lineup of trusted brands across frozen meals, snacks, condiments, and plant-based foods, giving it a solid foothold in categories that consumers continue to buy regardless of economic conditions. Its scale in their packaged food industry provides pricing power and efficiency, while ongoing innovation keeps legacy brands relevant to shifting consumer tastes. For dividend investors, Conagra's reliable cash flows from its essential product mix support steady payouts, making it a defensive yet rewarding stock that can provide both income and long-term security in a balanced portfolio. And that wraps up our look at 3 discounted US dividend stocks to keep on your radar this September. Applied Materials gives you growth in the semiconductor space, Comcast brings steady cash flow from broadband and media, and Conagra adds that defensive backbone with everyday food brands people buy no matter what. I'll continue to try and seek value with dividend paying stocks on a month-to-month basis, so if you found any value in today's picks, don't forget to like, subscribe and hit the bell notification so you never miss an opportunity to grow your portfolio. Let me know in the comments which of these stocks you think has the most upside potential, and thanks for watching. As always, invest smart, stay patient, and I'll see you in the next one. For now, this is the Geordie Pig Investor, over and out.